On March 21, 2026, global financial terminals look like this. Red across the board, aggressive downward trends, and extreme cross-asset volatility. But if you look closely at the data, the standard correlations are broken. In India, the rupee has collapsed to a record low of 94 to the US dollar, amid a massive exit of foreign capital. Yet domestic equities are actually bouncing back. At the same time, an active, kinetic war is escalating in the Middle East. Historically, this triggers a massive flight to safety. Instead, gold prices are experiencing a severe correction, dropping rapidly from their recent peaks. These asset dislocations result directly from a macro shock transmission moving through the global system. To understand why, we trace the causal chain backward, from physical energy flows in the Strait of Hormuz to U.S. monetary policy at the Federal Reserve, ending at localized liquidity interventions by the Reserve Bank of India. Pricing risk requires mapping linkages between these nodes. The traditional risk-on, risk-off playbook no longer applies. The market is now operating under a new regime, dictated strictly by energy-driven inflation. The origin point for this market behavior sits squarely in the escalating conflict between the U.S., Israel, and Iran. The scale of this kinetic action is immense. U.S. forces have reported striking over 7,000 targets in Iran, and the Pentagon is actively seeking an additional $200 billion in funding to sustain operations. All this military force converges on a specific geographic choke point. 20% of global oil flows must transit this exact corridor. Iran has responded by threatening transit fees and targeting regional infrastructure, putting that 20% at immediate risk. This chart tracks the immediate pricing reaction in global crude markets. Brent crude has elevated past $100, settling near $112 per barrel. The Indian basket experienced an even more aggressive upward spike, peaking at $156 earlier this week. The strikes on facilities like Qatar's Ras Laffan are causing severe geographic dislocations in natural gas markets as well. You can see a massive divergence here. European gas prices spiked by over 30% following attacks on Middle Eastern gas fields. Meanwhile, the heavily insulated U.S. Henry Hub price remains relatively flat, holding near $3.80 per MMBTU. MMBTU stands for 1 million British thermal units, a standard measure of heat content used to price natural gas. Active evacuation alerts at major regional energy facilities and direct physical supply threats have altered forward commodity pricing curves. Traders are pricing in long-term supply destruction. This kinetic action builds a high-risk premium directly into global energy costs, establishing a structural floor that resists traditional downward price corrections. That energy inflation floor dictates the monetary response in Washington. Because energy costs factor into the production and transport of nearly all goods, sustained high oil prices guarantee that headline inflation remains overwhelmingly sticky. This visual represents the Federal Reserve's dot plot, which charts each official's projection for the central bank's key short-term interest rate. As the energy shock persists, the expected easing cycles systematically disappear from the matrix. We are left with a rigid monetary reality. The federal funds rate is deeply entrenched in a hawkish posture, locked firmly between 3.5 and 3.75%. This higher-for-longer policy inflicts immediate collateral damage on U.S. equities. High capital costs have pushed indices into correction territory, with the Nasdaq hitting 6-month lows. This brings us to the most glaring anomaly of the March 2026 data. If there is a major global war, why is gold severely correcting? This chart overlays an inverted U.S. yield curve against the spot price of gold. It illustrates a strict inverse correlation between sustained high interest rates and the valuation of zero-yield assets. Gold pays no interest or dividends, so when cash yields a guaranteed high return, investors dump gold to buy bonds. You can see the precise magnitude of the correction here. Gold dropped from a psychological peak of $5,000 down to a current reality of $4,607 per ounce. Institutional portfolio models automatically adjust their risk weightings. When the cost of capital remains exceptionally high, the math dictates reallocating away from anything that doesn't generate a yield. The opportunity cost of holding non-yielding assets in a hawkish regime has entirely superseded the traditional geopolitical fear bid. The market has redefined how it prices safe havens. This high-rate environment in the U.S. creates an immediate gravitational pull on emerging markets, particularly within India's financial ecosystem. This split-screen visualization illustrates the mechanics. A hawkish Fed policy and a surging U.S. dollar act as a vacuum. Institutional capital is pulled out of emerging markets and redirected back toward high-yielding American assets. The sheer scale of this capital flight is massive. Foreign institutional investors, or FIIs, dumped over 77,000 crore rupees in March 2026 alone. FIIs are large foreign corporate entities, like mutual funds or pension funds, that invest in a country's financial markets. As that capital exits, it crushes to local currency. The rupee broke through historic floors, plunging to a low of 94.05 per US dollar. Even with the currency collapsing and foreign capital exiting at a record pace, the Nifty 50 and Sensex both staged resilient intraday rebounds. Part of this index buffering comes from internal market mechanics. Domestic capital rapidly rotated into PSU banks, metals, and IT services, carrying the broader market upward. Isolated micro-catalysts provided extra buoyancy. Positive guidance from Accenture lifted the IT sector, while news of an SBI mutual fund IPO pushed state bank stock up over 3%. But domestic rotation and corporate news are not enough to counter 77,000 crores in foreign selling. The true macroeconomic driver of this resilience is massive artificial liquidity support. The Reserve Bank of India aggressively combated the tightening liquidity by deploying a specific mechanism, injecting 75,000 crore rupees directly into the banking system via variable repo rate auctions. A variable repo rate auction is a tool used by the central bank to lend short-term funds to commercial banks at a fluctuating interest rate, injecting immediate cash directly into the economy. This intervention was executed under the RBI's newly approved Utkarsh 3.0 strategy framework, a regulatory blueprint specifically designed to ensure systemic stability during global shocks. The localized liquidity buffer engineered by the central bank is currently masking the stale of capital flight, decoupling equity prices from the underlying currency crisis. We now have the complete picture of this macroeconomic causal chain. Geopolitical friction in the Gulf has handcuffed the Federal Reserve by guaranteeing sticky inflation. The resulting high interest rates in the U.S. have exported a severe liquidity crisis directly to emerging markets. We are left with a stark global dichotomy. Western equities face relentless rate-driven corrections, while emerging markets survive entirely on internal central bank life support. This Nifty 50 chart outlines the strict technical parameters you need to monitor. The market established a hard support floor at 22,930 and a resistance ceiling near 23,378. Defending this 22,930 floor tests whether RBI liquidity injections can withstand heavy foreign selling. Outdated binary risk models fail to account for a regime where rates stay higher for longer. You must abandon them. Generating alpha in 2026 relies entirely on measuring two competing forces: the physical transit of energy through the Strait of Hormuz, weighed against the absolute scale of RBI balance sheet operations.